The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Thank you very much for attending today's webinar entitled Exploring Creative Solutions, Captives. Are you good enough for captive insurance? Today, we are joined by Stephen Gibson, who's the president of Dealer Risk Services, and he's also the program manager of Dealer Management, which is a homogeneous captive insurance program designed specifically for dealerships. Stephen Gibson, prior to his current roles, he was a producer at Zurich, which was formerly Universal Underwriters. He's also worked with Century. He has 30 years of dealership insurance experience, and he has been a panelist and author and been relied upon by many organizations within the automotive industry when it comes to insurance expertise. I had the opportunity to get to know Steve through the National Association of Dealer Counsel. And my name is Adam Crowell. I'm General Counsel and President of ComplyNet, and we are very happy to have Mr. Gibson joining us here today. Steve's going to go over the agenda to get started. Steve, thank you very much for joining us.
Thank you, Adam. We appreciate the opportunity and always are grateful for the participation and partnership of ComplyNet. So today's agenda, we're going to talk about the market, the insurance market, what it's doing and why it's doing what it's doing. We're going to look at some loss-sensitive options of what you can do to help control your premiums at your dealership. And then we're going to talk specifically about captive insurance, give you kind of a captive 101, how it works, why it works, and then look at some real-life examples of specific dealership group and how they would have performed had they been in a captive. Lastly, we'll talk about the ideal candidate, and in an overall sense, give you an idea of if you think you are the type of dealership that would fit well into a captive. So here we go. The first item ripped from the headlines, and as an insurance professional, these are the types of things that we see come across our desk every day from the insurance journals and publications. Oftentimes we are asked by insureds, I don't understand why my premium is going up. We don't have any type of litigious environment in my particular state or area, or perhaps we haven't been affected by any type of catastrophic issues. Understand that the insurance market is a global market. So when we have a disaster occur in Beirut, like with the bombing, it affects the global insurance industry. I know for us as Floridians, we breathed a sigh of relief when Hurricane Isaias passed to the east of us and virtually did not affect Florida whatsoever. However, in looking at the end result of the hurricane, the losses are expected to exceed $4.2 billion for the U.S. and the Caribbean. So again, it is a global insurance market. So when things change anywhere in the global insurance industry, then we'll see the ripple effect at our particular dealership and in our domestic insurance world. So the current state of the market. So we're talking about why things are going up. And very simply, folks, insurance is all about insurance companies making a profit or making the profit that they expect to make. So when claims get out of control, either through catastrophic claims affecting the property market or the inventory market, claims affecting the EPLI market or the D&O market, or litigation trends that cause the claims activity to increase, insurance companies are affected in their profitability model. When that happens, they have a couple of choices. One of the choices is to withdraw from that particular market segment. The second choice is to raise premiums. And in short, that's what they do. We see some that raise premiums, other that withdraw from that market segment, creating a void in the level of competition. And it's not necessarily about them being profitable. They may not be as profitable as they want to be in their model. I think when we looked at the previous slide, Zurich was a good example. In Zurich felt because the claims were high, they were going to remain in the, they weren't as profitable as they wanted to be. The answer to counter that obviously is raising premiums. So let's look at the insurance options. Really, when we talk about risk and how to handle risk, there are 4 options. The first 3 are the most well-known, and the first, of course, is risk avoidance. If you don't want to have an automobile accident, you don't go out and drive your car. If you don't want to get a sunburn, you don't go out into the sun. You know, risk avoidance simply means don't do it whatsoever, and therefore there will be no risk. Well, that's not an option, and that's certainly not an option for car dealers. The second risk option is to transfer the risk 100% to an insurance company and therefore take a minimal amount of risk. So we're going to hand everything over to a company, let them handle the risk for a fee, and we will minimize what our exposure might be to adverse claims years. The third option is risk absorption, which means we'll assume all of the risk. Again, this is kind of like risk avoidance. It's very difficult to do and very risky to take all of the risk with any type of market segment or any type of exposure. So really that leads us to the 4th option, which is a loss-sensitive program, a hybrid alternative. With a loss-sensitive program, understand that the very basic is it is a risk-reward scenario. We're going to take a certain amount of risk to receive a certain amount of reward. When we look at loss-sensitive programs, we see the large deductibles and the retro plans that everyone's familiar with, the incurred loss retros, the paid loss retros, but we also see captives. And captives really come in 3 forms. They can either come in group captives, like the type of captive that we developed for the automotive industry. And these group captives can either be homogeneous, everyone of like kind, or they can be heterogeneous, which is a complete mixture of different industries. There are cell captives, which are isolated for specific risks, or there are single parent captives. Single parent captives are oftentimes used when a particular risk is exceeding $1 million per year in claims. Really works better with upwards of $2.5 million per year of claims. So even though a dealership or dealership group may say, well, you know, we're paying $1 million a year in insurance, that doesn't necessarily qualify you to make a good choice for a single parent captive. It's moreover prudent to look at the losses and start backing into the premium from the losses. So let's talk about what a captive is. A captive is essentially nothing more than an insurance company owned and operated by the members or member for the benefit of the member or members. The driving forces behind making captives very appealing to the marketplace is really encapsulated in one small nutshell, and that is the instability in the marketplace. So when competition in the marketplace starts to wane and the coverages that we enjoyed the year before and the deductibles we enjoyed the year before are all of a sudden off the table, and everything is starting to, what we call in our industry, harden from a pricing and a forms perspective, then we see captives come into vogue as a very viable option. They're also a good viable option when we have new and emerging exposures. So when things start coming onto the marketplace and into view that weren't previously exposures, and or we have the need to try and change things such as buyback deductibles, etc. In looking at the difference between the traditional marketplace and captive insurance, this slide will show you really what the two models look like. With the traditional insurance program, you buy a policy from XYZ Insurance Company, and they issue the policy with your name on it and their name on it. They determine the rating structure, they handle all of the claims, and they keep the unused underwriting profits, or they absorb the losses. What a lot of people don't understand is that behind the scenes, these carriers, whether it be Travelers, whether it be Zurich or Hartford or CNA or whoever it may be, they don't keep 100% of the risk. They lay the risk off to Swiss Re, Gen Re, Munich Re, Am Re, a variety of reinsurance carriers, those carriers that are affected globally, and that's what handles the catastrophic risks, be it large lawsuits, product liability, or even property. Creating a captive really does the same thing. You still have a policy issuing company. We call that the fronting company. And then you have reinsurers behind the scenes. It just so happens that with a captive program, one of the reinsurers happens to be the captive itself. So the captive in this scenario that we're going to look at is going to maintain the first $400,000 of any one claim, and then the other reinsurance carrier will handle the excess up to $1 million when the umbrella carriers kick in. The difference between the captive and the traditional insurance model is with the captive, the members control who gets in the group. The members have claims settlement authority, and the members are able to retain the underwriting profits. They will also, mind you, sustain the underwriting losses if there are any, and that's why it's so important with a captive, particularly a group captive, to control who can get in and who can't. The benefits of the captive program are, in essence, the stability and control of the program, being able to provide consistent coverage, predictable premiums, give claim settlement authority, return of underwriting profit, choice of counsel, and the ability to control membership. Additionally, with a captive platform, you can use it to leverage the purchasing power for other areas of concern, particularly for dealerships. And we all know that inventory coverage has become very problematic, more expensive. Umbrella coverage, for those of you that have already gone through a renewal, you might have seen those prices double. Management liability, when we think about employment practice liability, you can just read the headlines and see what's happening to that market. And then, of course, you know, the thorn in everyone's side, which is group health insurance. All of these can be entertained and dealt with through various captive types of programs with the proper amount of care. The captive concept is all about the members in a member-owned group captive, which is the portion that we created for the automotive industry. But members would own the program, they would control the program, they would determine the voting structure, whether it's done one member, one vote, or whether it's done by a number of dealerships, number of employees, total revenues, etc. It is when you create a member-owned program, it is truly that the members have control, total control of the program. Captives are unique in the fact that they are what we call in our industry an unbundled approach. When we talk about the bundling for insurance companies, we talk about insurance companies all aspects of the insurance policy. So they would determine the coverage, they would determine the rating structure, they would determine how claims are paid, they would determine the counsel that is used, they would determine all of those aspects. With a captive, the captive core is the insurance company, and then the captive has the ability, when I say captive, folks, I'm talking about the members. The members have the ability to select all of the different spokes of the wheel, as I call them. They have the ability to select the captive manager, whether it's SRS, whether it's Marsh, whether it's Captive Resources, whoever it may be. They have the claims TPA, whether it's Sedgwick or Gallagher or NARS or whoever it may be. They even have the ability to select and or change the domicile. Our captive is currently domiciled in Vermont, but if the members decided that they wanted to domicile it in Cayman, Bermuda, South Carolina, Tennessee, wherever they so decided, we could easily move it without disrupting the operation of the insurance company. It's all about control by the members. So let's talk about what coverages are best placed inside the captive. The coverages on the left-hand side, if you think about them, they are frequency driven. Workers' compensation claims are frequency driven. Garage claims and general liability claims are frequency driven. A good risk manager can predict how many claims he or she will have in a given year for any of these lines. If you look at the items on the right, those are typically the items that are placed outside the captive. If they're placed inside, it is with a tremendous amount of care, because if you look at them and you think about it for just a moment, they're all severity-driven lines. They're very unpredictable. We rarely see a crime claim except once every 7 to 12 years with a dealership, and then it's a very nasty claim. Normally an employee dishonesty claim that gets into the 6 or possibly even 7 figures. The same with umbrella claims. Most claim into your umbrella, so they don't happen that often. EPLI claims are driven by a lot of social issues and trends in our social environment. The same with pollution coverage and cyber coverage. Property and physical damage down at the bottom, those are driven by acts of nature and typically more affected from a rating perspective by CAT issues, catastrophic issues such as wind, hail, flood, wildfires, earthquakes, etc. So again, what the items on the left-hand side are predominantly belonging in the captive. The items on the right can go into the captive. It's best to either take tremendous amount of care or perhaps fund the deductibles into the captive and get that money off of your books. There are 2 levels of reinsurance with the captive that are very important. The first is the specific, and that is the level at which the reinsurer attaches. If you remember our model, the captive in this model would take the first $400,000 of any claim, and then the reinsurer would attach at $400,001 and take that all the way to $1 million, which is where the umbrella would attach. The 400,000 level can be 300, it can be 350, it can be 500, but that's the level that the reinsurer would drop down to. So the 400,000 in our model is the exposure to the captive. Probably the most important part of the captive is the excess and aggregate reinsurance. And what this does is this says, okay, we know we have a loss-sensitive program. We know we have a risk-reward program. We know that we have a certain premium that we're going to pay in, but what is the maximum exposure? If I keep having claims, if I have, God forbid, the worst year ever, what is my maximum exposure? And what is the maximum exposure to the captive as a whole, assuming that all the members had the worst year ever in the very same year? By placing the aggregate excess reinsurance, we put an absolute cap on that. So we put a stop where all of the counting will end. And I'll show you how that works in just a minute. So the premium breakdown inside the captive, you have the total premium, which is the fixed cost, which is the administrative cost, the cost of the front, the specific, the aggregate, handling the claims, the loss control, the actuary, the legal, the captive management fees. All of those fit into the fixed cost. And then the balance is the money with which the member pays claims. And if we think about this from $1 worth of premium, we're going to have fixed cost of about 35 to 40%. And then the member's loss fund, which is going to be 60 to 65%. Here's the part that is most interesting, and here's the reason that a captive will take the fluctuations out of the marketplace. We already talked about how the insurance market has cycles and how the reinsurance market kind of goes crazy and prices increase when we have catastrophic things happen throughout the world. But if you look at the captive, the fronting fee, the cost to have that piece of paper that is the so-called policy, is going to cost 5 to 6.5%. The specific and the aggregate reinsurance is going to cost 15 to 17%. So what I would suggest here is that out of every dollar in premium, 23%, give or take, is insurance. That's it. The rest is not insurance. The rest would amount to your loss fee, the cost of legal and accounting, the management fee, the cost to handle the claims, etc. So by isolating the pure insurance cost, if the reinsurance market goes up 10% or 15% or even 20%, that's 20% of 23%. So we've actually taken and we've minimized the exposure to the insurance market by owned with a captive. Sorry. I'm going to take a sample member and then I'm going to run through some claim scenarios. I'm going to do this very, very quickly, and then we're going to look at some a real life scenario. So pardon my speed, but please stay with me and we'll be happy to send all of you the slides after the webcast. So if we have a member that has $500,000 in premium, we're going to break it down into his or her loss fund, which is about 60 to 65%, and then the fixed cost, the administrative cost of $175. So out of the premium of $500,000, if the member has no claims, then at the end of the day, their premium would be $175,000. We're going to take that loss fund of $325, if you recall, that was the loss fund, and we're going to break it down and put it into a frequency fund and a severity fund. This is the so-called A fund, B fund model, which has been approved by the Internal Revenue Service as being an insurance product. So we're going to put the money in there. Most of the money is going to go into the frequency fund, 75 in the severity, and then the reinsurer would attach it, 400,000. We're going to secure one additional A fund with a letter of credit or cash, and this is going to be the maximum premium. So if you remember, the member has a $500,000 premium. The minimum exposure, 0 claims, is $175. The maximum exposure, worst year ever, is going to be $750. One additional A fund. I'll show you how that works. So the second frequency fund, the so-called gap collateral, is going to take the member up to the maximum premium. All the members have the same maximum premium, not the same number, but the same ratios. So I'm going to go through 4 loss examples. Again, I'm going to go quickly, so please bear with me. We have a member that has 25,000 in claims. All of the claims are under 100. We would go to the frequency fund because that handles the claims under $100,000. Pull out 25,000. That leaves 225 remaining, 75 remaining in the severity fund. For year 1, this member has a surplus of $300,000. The money would remain in his or her account until such times as the actuaries advise the board of directors, which is the members, that the IBNR and the reserves had adequately paid out and it was time to declare a distribution. Typically, this is going to be at the end of year 4, and typically what would happen is the board would say, let's give back half of year 1. At the end of year 5, they'd say half of year 2, 25%, half of what's left in year 1. At the end of year 6, half of year 3, half of what's left in year 2, and close out year 1. So once the distribution starts, the distribution would continue because the claims have played out. The incurred but not reported has adequately passed, and the actuaries and the accountants are saying, we can't keep the money in reserve anymore. We have to declare a distribution. The distribution would be the same for each member, understanding that each member would have a different amount in his or her fund because each member has a different premium. So let's look at a sample scenario. An average year, we have 150,000 in claims. All claims are under 100. Go to the frequency fund, pull out the 150, leaving 100 in frequency, 75 in severity. For year 2, this member has a profit in their account of 175. It's not combined with year 1. Each year stands on its own like a silo. So let's take and make it a terrible year. We have the 150, I'm sorry, there's a typo. It's not 15 million. We have $150,000 in total claims. All claims are less than 100. So we would pull them out of the A fund. That would leave 100 in the A fund, 75 in the severity fund. Then we have a $1 million claim. What happens with a catastrophic claim is the first thing is the insurance carrier, the reinsurer, comes in and says, okay, we've got everything over 400. So we actually have, for this $1 million claim, we have 400,000 to pay on it. The first 100,000 is always the frequency. So we would go to the frequency fund, pull out 100. That would leave us 300 to pay on the claim. The second portion is the severity fund, the severity portion. And because this is a severe claim over 100, we would go to the severity fund, pull out the 75, leaving 225 to pay on the claim. This member has no money. At this point, because it is a severe claim, we do not go to the second frequency fund. It is this amount that would be shifted and shared among the other members in proportion that they are to the captive as a whole. The reason this happens is this makes the A fund, B fund model acceptable and working for the Internal Revenue Service and therefore tax deductible. Okay, so we're going to go one step further, and for year 3, this member has a 0. It doesn't affect year 1 or year 2. Again, they stand on their own. We're going to look at one last scenario, and this is that same member, and they have 0 money, but they continue to have claims. They have 20,000 more in claims. Where does the money come from? Do we go to the other members? The answer is no, because these claims are all under $100,000 and frequency claims. So this is the amount that would be secured by that letter of credit, the second frequency fund. So for year 4, this member has a negative 20, but if you can look, the member has still had a very profitable captive experience. We do not tap into the LOC. We bill the member, and we bill them in year 2, 3, and 4, because as we all know, claims have reserves on them, and it takes a while for them to pay. Minimum cost then for the captive is the claims fund, the administrative cost, and the second frequency fund. All captives have to be collateralized, so there is always a cost for the share of stock. That's determined by the board of directors for each individual captive. So I wanted to show you some real live numbers. You know, how does this look? Because everything else is really just hypothetical. So this is a dealership group. We'll leave where they are and who they are out of the equation. But this is a dealership group that had a captive premium for their garage of $447,000. So we took the captive and we went back and we said, okay, what would your results have been if you were indeed paying $447,000 a year? And we plugged in the losses. And if you look at the losses and then you look at the captive admin cost and you add them up, then you can come to the final premium section and you can see what their premium would have been at the end of the day. Obviously, what this does from a insurance perspective is it puts the ball in the hands of the insured. And when Adam talked about earlier, are you good enough for a captive? When you look and look and determine how you would have performed, and moreover, you know, this is without any claims handling, any cost control over handling claims. This is without the dealer being able to use their own counsel, and this is without any added loss control measures and compliance measures initiated at the dealership. And as you can see, with every single year, they were profitable on the garage. When you look at the workers' compensation, they did have a bad year. 2016 was a very adverse year, and they did have some terrible losses in that year. However, if you remember, the captive premium, the maximum premium is one additional A fund. So even though it looks like they sustained well over $1 million from the admin cost and the claims, we would have capped that at 917. That would have given them a negative year of 290. But if you look at the rest of the years, they've still been very profitable. We understand, and I think it's been proven in the industry that even the best of dealers, 1 out of every 7 years, we're going to have something happen. So the best that we can do really is to try to minimize the expenses and minimize the losses in a bad year and maximize the gains in a good, solid, profitable year. This is taking a look at the two lines of coverage combined, the workers' compensation and the garage. And if you look at it, folks, even with a bad year in 2016 that this member sustained from a work comp perspective, they still, over a 5-year period of time, saved a little north of $1.2 million, which is tremendous. So what it gives you the ability to do is pay in a competitive premium. It's never going to be the lowest premium, never going to be the highest. It's going to be kind of middle of the road. Pay in a competitive premium. And if you have the ability to control your losses, the captive will absolutely, without a doubt, provide you with the lowest premium over time. By the time the distributions are sent back, you will indeed have the lowest premium. So if you think back about it, we started with a premium of $1 million. For 2015, that premium would have been half of that. And the same with 2019, it would have been almost half of that. Still making money in 18, still making good solid money in 17. 2016 would have been a bad year. But, you know, it's uncertain exactly how bad that year would have been, because if you think back about the slide that we talked about with the captive being unbundled, the captive members control the claims. You have claims settlement authority. So, you know, one of the objections we always hear is the insurance company settled the claim without even asking me. The captive takes that sort of scenario away, gives you claim settlement authority. You can say, offer them half, let's go to court, you know, settle for this amount. You're at the control of what's going on, because at the end of the day, with a captive, it is your money. So the captive concept, the process, who fits into a captive, accounts really that have, from a group captive perspective, over $250,000 in pure garage liability and or work comp. And when we say pure, we're talking about take out the property, the inventory, the EPLI, the crime, the pollution, the umbrella, take out all of that, because we want 250,000 or more in the items that you can control. We're looking for people that are financially secure, that have a commitment to the concept. It's not something you jump in and jump out, because understanding that we know you're going to have one bad year out of 7, and we just don't know when it's going to be. We want people with a succession or a continuation plan, and those especially that have a desire and a commitment to be accountable and to take control of their risk, with compliance measures and policies and procedures. The captive is for those that outperform the marketplace. So if we have someone with the attitude of, well, just let the insurance company pay for it, that's not the mindset that belongs in a captive. We want the people that say, I'm better than everybody else. I run a better dealership than everybody else. We have our claims under control more so than the rest of the industry. So that's what we have, and I thank you, and I certainly thank Adam for his time today and for hosting the webinar. I thank each and every one of you for attending. Again, we'd be happy to discuss what we created. We did create a homogeneous captive specifically for the automobile dealer industry. We are domiciled in Vermont. We have Cedric as our claims administrator. We have Travelers as our insurance carrier. So it's pretty solid from top to bottom. And we also are gracious enough and thankful to have ComplyNet as our loss control provider. So Adam, thank you very much.
Yeah, thank you very much, Steve. And if anyone has any questions, please submit those. We do have a couple questions that have come across. And in particular, there was a question that talked about the savings, Steve, and maybe you can speak to this, but the question was, when you were talking about the savings on the graph, were those savings, did those include any sort of interest? Is there interest? And also, does that also, you also mentioned tax deductibility. Is that savings, is it taxed?
Those are great questions, Adam. And when I started as a young pup in the insurance industry, I remember going over to visit one of the larger carriers, and they were boasting about having a 105% combined loss ratio. And what that meant was when they took their administrative cost and they added their claims, it wound up being 105%. And I was so puzzled at how they could be very proud of that. And it was because they were making so much money on the money. While your claims fund is being held and awaiting to pay claims, it will gain investment income. So we as well, inside the captive, and not just our captive, but all captives, they have an investment portfolio advisor. So you will make to be paid out in claims. That's important with garage liability and workers' compensation, because they're what, meaning that when the incident happens today, the claim may not be fully paid out for 3, 4, 5 years. During that time, the investment income would accumulate for that particular member. As to how the money is treated coming back when it is a distribution, my guess, I'm not an accountant and don't play one on TV, but our suggestion is that it is going to come back as ordinary income. That would be a matter for your particular CPA and how you would want it to be treated. There are always options with a captive to maybe take that money that should be distributed and transfer it over to your secondary frequency fund. So as opposed to having a letter of credit, you could leave the cash in there gaining investment income and therefore not have to take the distribution. There's also the option to take a premium holiday, meaning use the money to pay for the following year's premium. Again, this is an issue for you and your CPA, but there are a lot of creative things that can be done with the money. Hope that answers the question.
Yes. Steve, another question that came across. It looks like both garage keepers and workers' compensation are currently set up as the captive insurance programs within Dealer Management Group. If the dealership only wants to put the garage keepers or only wants to put workers' comp into the captive insurance program, is that an option?
Adam, that's a great question as well. And certainly it is an option as long as we maintain the minimum. And the reason for that minimum level of premium is the members want all of the other prospective members to have enough money in their claims fund to be able to handle a normal claims year. So, you know, if someone had $100,000 or $75,000 in premium, the numbers just don't really work. They're not really large enough for the captive scenario. But we understand that many dealerships are tied to their state association where they have their workers' compensation, or they may be tied to someone else where they have their garage. We're more than willing to entertain either line or both lines as long as it makes financial sense.
Steve, another question. Why not have other insurance lines like cyber within the captive insurance program?
Adam, that's a great question as well, and all good questions. You know, the reason is that cyber is very much cat-driven. I mean, nobody saw what happened coming to Home Depot, nor Target, nor Sony, nor any of the other big institutions that were hit by a cyber attack. It's not something really that has any type of frequency to it that we can point to and say, okay, we know we're going to have 5 cyber attacks per year, and here are the procedures that we can do to mitigate them and to prevent them from happening. Well, the one thing that we do know is that the cyber criminals are very, very smart, and they may be coming from other countries. And at the current time, it's just too unpredictable. Now, that being said, if you want to take a higher cyber deductible to help offset the premium, then we could always consider funding that deductible into the captive, getting that deductible money off of your books, and it would be in a captive, potentially in a segregated cell available for you to use should you have an unfortunate incident.
Another question, if the cyber program is not included in the captive, so to speak, where would the dealership get the other lines of coverage that they need to protect the dealership? Things like open lot and some other coverages like that.
Sure. And I can only tell you how we do it at Dealer Management Group. We use the leverage of the group as a whole to secure coverage from the open marketplace. And here's the difference. The difference is if you take, for instance, you have $40 million worth of inventory or $50 million worth of inventory, as opposed to going to market with that 50, we would take the group as a whole and go to market. It doesn't mean that people are going to mix policies. It doesn't mean that people are going to expose one another to each other in the event of a loss, because we may have a dealer in Illinois and we may have a dealer in South Florida. What it means is that we're going to use the leverage of a whole lot of premium versus a little bit of premium to negotiate the rates downward. What we found is that we can easily, by using this type of method, we can easily move the needle down 5, 10, 15, potentially 20%, as well as create some other opportunities down the road.
So, Steve, what you just described sounds an awful lot to me like the bundling of lives together when it comes to health insurance benefits. Is it something akin to that and leveraging that?
Similar, yes, sir.
Okay.
Similar. Each member would stand on their own. Each member would have their own policy. But I think when you negotiate with a larger mass as opposed to a smaller mass, you invariably wound up being able to negotiate better coverage and pricing.
All right, one final question, Steve, and then we'll be wrapped up here. The question is, what steps should I be taking at a dealership level to put myself in the best position to be accepted into a captive insurance program?
Well, that's an easy one, Adam. I think that you need to look at a firm that is a compliance-driven firm, and I would use this as the opportunity to tout ComplyNet a little bit. The unusual part about the automobile dealer industry is when you look at an industry that might do anywhere from 300 million to 1.5 to $2 billion in sales. If we looked at any other industry, manufacturing, distribution, etc., what you would find is a level of compliance people inside the organization. Environmental compliance, HR side, heavy on the safety side, risk management people. It's unfortunate, but it's a fact that car dealers, they typically don't have those levels of expertise. So what you have to do is you have to develop as good a risk management team internally as you can. And then I think you need to lean on some of the industry experts that we have out there, like ComplyNet, that can bring so many tools to the table and help you enhance your internal team, as well as provide the things that you need to outsource.
There was one final question across. I really apologize, but I think it's a pretty important question. The question is how do we go about getting an evaluation done to see what sort of savings we would have had we joined a captive program? Steve, do you want to talk to that one?
Yes, of course. And everything with the captive is actuarially driven. So what we need to do is we need to look at 5 years worth of loss history and then come up with a loss pick. And when I say the loss pick, it means we will come up with the average amount of claims that you would have had in a given year. And from there, we can develop more actuarial science than it is the standard. We can go back and show you exactly what the premium would have been had you been in a captive. Now, one caveat, and I need to explain this, and I'll do it very quickly, but if you are in a member-owned group captive, understand that you need to put on your insurance professional hat for just a minute. The captive premium, as I mentioned before, is never going to be the cheapest. It's never going to be the most expensive. It's going to be competitive, but we're going to try to underwrite it so that we, as an insurance company, meaning the members that own the insurance company, can underwrite it to a profit. Because there is always, with a captive, an exposure to another member in the severity section that we looked at, you never want to underprice it. We always want each member to have enough money to pay for his or her claims in an average year, and only expose each other and minimize that exposure if we have a terrible year.
So, Steve, one last.
That makes sense?
Yes, very much so. How much does it cost to go through that evaluation process?
How much does the what, sir?
For a dealership to go through that evaluation process, what's the cost of that?
There is no cost. There is no cost. Dealer management group, if we were to receive a submission from a dealer, that we would do it at no cost. We are absolutely looking for the best of the best. All of our members, should they, any prospective dealerships that would like to join dealer management group, we get we develop the cost for them, we provide it to them, and then it is submitted to the board of directors for approval.
Okay. Well, thank you very much, Steve Gibson. We'll wrap this up now. Everyone, thank you very much for joining here today. Stephen Gibson's information is on our screen right now. Please feel free to reach out to him and get an evaluation of your dealership just to see what those numbers would look like. If anyone wants to reach out to me directly, my name's Adam Corral. My cell phone number and my email address are available here. So please feel free to reach out to me if you have any questions. And everyone, thank you very much for your time today, and have a great rest of your week. So everyone.
Thank you so much, Adam.
You're welcome. Thank you, Steve.